It's 11:10 and we're going to start the next round with Jing Rong. Okay, Go Jing Rong. So Go Jing Rong is the director at Risk Lighthouse, a global research and consulting firm with offices in Atlanta, New York, and Shanghai, Shenzhen, and Singapore. Jing Rong is the co-founder at NRP, which is a digital platform that provides best-in-class insurance solutions built for startups in Asia. Jing Rong is also an adjunct faculty and lectures part-time at the Singapore Management University and Nanyang Technological University, and he teaches a wide variety of courses from actuarial science, statistics, finance, and data science courses, both the undergraduate and PhD level. And currently, he's also running a social enterprise, Consider Aid, that seeks to help those who need help with those who can help. Okay, so Jing Rong is going to give a very good presentation on government support for SMEs in response to COVID. Okay, he's going to use this Wang Transform theoretical model. So I consider this like a risk management framework for governments. Okay, over to you, Jing Rong.
All right, so thanks, Paul, for the great introduction, and let me pull up the screen sharing. You guys able to see the PDF? Okay, I guess. All right, cool. So before I begin, first off, I just want to thank Paul, Valerie, the organizing committee, Fred as well, for putting this all together, right? I was here last year at the Asian Actual Conference. It was face-to-face. This year, because of COVID-19, right, ties in with my topic. I can only imagine how challenging it is to really put everything together. And I have to say the experience thus far has not disappointed. It's been a great experience. The organizing committee has been extremely professional. So hats off to everyone. Yeah. And yeah, so today I'll be giving a presentation on this paper, right? And that I wrote with Professor Sean Wang and our team of co-authors. Before I dive right into the paper, maybe I just give like an overview, right, of like the inspiration for this paper. So actually, like as the name suggests, it actually came about because of COVID-19. And it actually came about during a discussion, like several discussions that we had with a couple of our government officials, partners, not in Singapore, right, but our like overseas partners. We were having some discussions, and they're hoping to have some like theoretical framework to guide like some of their government decisions. And hopefully in this setting, we hope that some of the models that we developed, our partners, they felt that it was very interesting, and we see some of the models actually being applied in the real world right now. So we thought it would be quite fascinating to actually have a chance to present it here in front of the actuaries. Of course, the paper itself, the key idea is that we ground it in a firm theoretical foundation. So there's a lot of theoretical framework, because ultimately, without that firm foundation, and everything will just be like very random and not very credible. And if I was speaking to like a more general public audience, I'll probably skip all the theoretical stuff. But given that we are actuaries here, I believe we will have a good foundation on going through. But of course, I'll be focusing more, given the limited time that we have, I'll be focusing more on the applications and the applications and the implications that the models have on the real world, and how this may actually help guide some policies that we see around the world today. So yeah, without further ado, so yeah, this is an ERM day, right? The enterprise risk management. So key link to our paper, I'll say, is that a lot of big companies today, we are focusing a lot on all the enterprise risk management. I feel that it's essentially something that's taking like center stage right now, right, around the world. But honestly speaking, for a lot of the SMEs, right, they still have a lot of growth potential when it comes to like managing the risk within the company. And that's where we feel our paper can come in to plug this gap. And of course, SMEs, they form, like in most economies around the world, they form more than 99% of the frequency of companies incorporated in the different economies around the world. So they are definitely very important. They hire, they employ a ton of people. And one of the key problem statement that we actually face here is a lot of these SMEs, they have some difficulty when it comes to acquiring bank loans, right? And the reason is fairly straightforward. As compared to established corporations, our SMEs, they actually have, they do not really have such a long track record, right? And yeah, by the virtue that these SMEs, banks do not know them as well. They are smaller in size. So sometimes they actually find it harder to acquire bank loans. And this problem, because of COVID-19, this problem has been exacerbated, worsened significantly. So hopefully what we introduce in some of our papers, some of the ideas that we introduce in this paper here will help to mitigate some of these gaps, right? And yeah, also interestingly, just a side note here, ever since our paper has been written, we start to observe that some of the measures that we suggest in our paper actually did get implemented by governments around the world. So yeah, it's a fairly heartwarming thing to say, right? So just an overview, I'll give a brief background on the key theoretical framework, the Wang Transform in this paper. Thereafter, we'll lay out some of the theoretical foundation there, and we'll then apply. Point 3, I'll say, is probably like one of the key idea. We'll be applying some of the frameworks that we've developed into the different proposed measures in helping SMEs around the world. So we have bridge loans, we have bank loans, we have interest rate subsidies, so we have tax burdens, tax reliefs, and whatnot. All right, and thereafter, we go into the idea of recall our initial perspective where SMEs find it hard to acquire bank loans. One key reason for that may be because banks are not that suited, or they have some challenges when it comes to assessing the credit risk of SMEs. So point 4 and point 5, and even point 6 lays out some of the key ideas of how our models can actually help banks, right? Or help like the finance industry in general when it comes to assessing credit risk. Right. And yeah, this is essentially the Wang Transform, where it actually converts in our setting here, it converts the loss curve to the price curve. Right. So yeah, this is just the definition of Wang Transform, where we actually take the inverse of the loss curve and then we do a transformation to it and plug it back into a Gaussian. Right. And yeah. And then we have the risk margin as well that we calculate by just taking the standard from the relevant domain from 0 to 1, calculating expectation to see like essentially what's the risk margin that needs to be paid, right, from between the price and the loss, right? And at the same time, what we have here, so the Wang Transform, what we saw just now previously, is the one factor Wang Transform. But if you guys, so there's a 2-factor Wang Transform that we actually apply in this paper as well. Which actually, instead of just plugging it back into a Gaussian, we just plug it into a student T distribution, right? Where the K degree of freedom is essentially a number of paired error terms towards the tail of the distribution, right? And yeah, basically a 2-factor helps to capture this increasing sampling error at tails of distributions. And this is actually a phenomenon that we commonly see in credit risk setting and default setting. So yeah, that's the reason why we actually use a 2-factor Wang Transform over here, right? Right, so going into the theoretical framework, right? I try to, basically the key idea here is we always try to value a company, right? We try to value an SME, and the key idea of how we value it, we just use our standard discounted cash flow, where the future cash flows are the income that's generated, right, by this individual SMEs. And yeah, that's basically a key idea of what we are doing here. And one key intuition that we are proposing is that within a company, there's what we call the book value and the intrinsic value. Book value, as we all know, is like on the book, on the accounts, right? Asset minus the liability, right? How it appears on the book. But then we also say that a firm should not just be assessed based on their book value, but at the same time, they should be their credit worthiness, or whether the value of their generating value to society should actually be assessed by their intrinsic value, right? Which we define in this case as the book value plus the future value that you actually generate. So yeah, so we define these 2 terms, right? Book value and intrinsic value, and we say that they are different, right? Where book value is a subset of our intrinsic value. So why did we actually make this distinction? Is because it allows us to model them differently, essentially. Right, over here, we model our IV as a standard geometric BM with parameters mu and sigma, right? So it's a random. And for our book value, it'll suffer a crunch. To make it more applicable to the real world, right? We give this event like, we specify to be like COVID-19, but of course it can be more general in terms of like other type like financial crisis events or generally events that affect like the market as a whole, right? But in the setting of a paper, we specify it to be related to COVID-19 to make it more applicable and more specific to the issue at hand. And yeah, so the key reason why we actually make a distinction between these two is we are suggesting that for some of the SMEs or even for some of the firms, right? The key idea here that we are proposing is some of these SMEs, they may be facing a short-term liquidity crunch because of COVID-19. But honestly, if we look at the future potential that they are actually able to provide, their intrinsic value actually is still positive, right? So even though the BV may be negative, but because of the future potential that they are able to provide is, there's still a lot of it, the intrinsic value is actually still positive. But because of the firm being unable to go past this difficult times, right? Because of lack of cash flow, because of the debt that they are unable to pay back, they have to declare bankruptcy. From the economy's perspective, right, we actually essentially lost a good firm, right, who's actually able to provide great value to the economy, but because of COVID-19 is unable to cover the losses from the BV portion, and therefore the firm has to shut down. So that's the intuition of how we actually develop this model, which we feel is actually the case for a lot of great firms in the economy today, right, who unfortunately have to like declare bankruptcy or shut down. We read it in the news, departmental stores, great food stores, they are shutting down. So we hope that our paper help to shed some light on some of the phenomena that we actually observe in not just Singapore, but like the economy around the world. So with that, what we have here is, as we defined earlier, our IV follows a geometric Brownian motion. So naturally, the log of the IV, right, at time period t, so we define a single time period model, right? So at the end of the time period, the log of the IV will naturally follow normal distribution, right, per the geometric Brownian motion. And essentially what we have here is we assume or we define that there's what we call the good firm and the bad firm, right? So generally speaking, as we can see here, right, over the course of the one period, okay, because of like the randomness of the geometric Brownian motion and because of your sigma term, there's the volatility, right? Individually, the good firm in green and the bad firm in red, they move up and down, right? They are volatile, right? They move randomly. But ultimately, at the end of the time period t, we generally expect to observe that a good firm to be at a higher position than a bad firm, right? That's essentially what we're suggesting here. And then at the end of the day, a bad firm is more likely to default, which makes intuitive sense as well. So a lot of times when we develop our theoretical models, we try to include this theoretical understanding so that we have the inputs that makes intuitive sense pass through a process that what we have here in this paper that makes sense as well, such that the implications and outputs that we actually generate will be logical and will be able to have real world impacts. So that's the logic that we have here. And yeah, coming back, we see that a bad firm is more likely to default. And in terms of the default model, we apply the Merton's distance to default model. For firms with different drift terms, so different mu, right? If you guys recall, your different mu. And yeah, so this is essentially how we actually managed to connect the drift and the default probability, right? So because so far we have always just been talking about the firms, the IV, right? How they actually drift up or drift down depending on whether their mu is positive or negative. But with the Merton's default model, we actually tie it back to the default probability as well. So that's what we have here. Okay. That is me the models. All right, so we have the Merton model. This is what I described. This is basically what I described. And yeah, finally we managed to prove mathematically. We managed to prove it mathematically rigorously that the default probability Q, i.e. the one that we actually observe, right? This Q is the one that we observe in the real world, right? That's essentially what we call the objective default probability. And by plugging into a Wang transform, all right, we showed that the earlier models, right, we proved them all, and we managed to show this very nice relationship here, right? That your default probability Q can be related to the risk neutral probability Q via our Wang transform, right? Well, of course, your lambda T is a transformation of your mu and your sigma, right, and your time period as well, right? But it's something that can be estimated. So what we actually have here is a very nice function that by observing the real world default probability or the likelihood of default, like on average, how often a firm defaults or whatnot, by observing that, we can plug it into the Wang transform and get a risk neutral probability, right? And why is this risk neutral probability relevant for private industries is because all this this risk neutral probability is essentially the probability that is the fair default probability that this private institutions, financial institutions should be using when it comes to pricing whether a firm is creditworthy or not, and in terms of what's the appropriate interest rate that they should charge these SMEs as well, right? So that's the relevance that we have here, and it's a very powerful expression that we managed to show here, right? And now that we're done with like all the more or less done with the theoretical stuff, now we seek to apply it. Okay, so ultimately we have all these proofs and everything, but I guess many of us, I'm being in the interest of time, I'll go right into the key application, right? That what we have here. The key idea that the key application I would say that we have here is when we actually apply our models, right? We saw that. So what we have here is essentially governments giving out bridge loans or banks giving out bridge loans to SMEs. And naturally, as one might suspect, that there's an optimal level of bridge loan, right? That so sometimes people like the word on the street is, or they hope that the government or the banks can give like handouts, right? Like give them more support and give them more bridge loans or whatnot. But based on the models that we have in our paper, we show that an optimal actually exists, right? Where if you give too little, it's not optimal. And more interestingly, that if you give too much, it's actually suboptimal as well, right? So it actually makes the case that money shouldn't be like given out, bridge loans shouldn't be given out like so freely, right? That's we provide mathematical foundation for that. And at the same time, something that's very interesting is that there exists an exceedance threshold that we discover based on our simulations, where essentially, if you notice, the curve here curves downwards, right? Based on different simulations. If the amount of bridge loans that you give exceeds like a certain number, like maybe 18 months or something in this context, it actually causes the net value creation to become negative, which is fairly surprising, to be honest, because who would have expected that if bridge loans were to be given out like for a prolonged period of time, the net value creation to the economy is actually negative when actually we are injecting more cash, right? But that's actually what we observe, which it makes sense as well, right? Because at the end of the day, if you were to just keep like pushing money into the economy without creating real value, we are just burning cash, right? And that is not sustainable at all. And that's what our model captures. And at the same time, another key idea that we showed in our model is we expect the supply side of the economy to recover fairly quickly, right? Based on what we found in the model, but a demand side may take a bit longer to recover. And this uncertainty can be captured within our model as well. So that's like another degree of freedom that we incorporated into what our model has here. And what's this? Oh yeah, so this is the insurance, the government funded pool. So it's a fairly straightforward idea, basically, and it's being implemented in Singapore and around the world. Basically, the key proposition here is that if banks are kind of worried to lend to SMEs, right? They are worried that they'll default. So what the idea here is suggesting is the government will be putting aside a pool of cash such that if the SME were to default on the payment to the banks, right? A portion of it will be subsidized, will be paid off by the government, right? So what this essentially does is that, in theory, right, what this is actually doing is that it allows banks to take on more risk, than they would otherwise be able to if not for this government funded pool, right? It sounds like a great idea. Then we analyze this proposal based on our model, and we do agree that this bank loan, this bank pool, right, this insurance government funded pool, it does provide some incentive, but the incentives are weak, right? I to say it's not the most efficient way of spending, right, by the government, right? So the key reason is fairly intuitive, right? We prove it mathematically, but the key intuition that I hope to share with everyone here today is at the end of the day, most of the bank branch managers, they are evaluated based on their MPL, right? And this is some based on the conversations that we have with our like our government partners, right? They are non-performing loans, right? So even though they are able to recover some of these loans, these non-performing loans from the government funded pool, but ultimately on this local bank branch managers, they will still be marked down, right? Because at the end of the day, the SMEs that they lent out to failed to pay back the money, right? And because of this, from an ex-ante position, the ones who's deciding to lend out the money are the bank branch managers, and they will not be incentivized to be lending to these SMEs in the first place, right? Which makes sense. So therefore, what we propose here is instead of having this government funded pool, right? This government funded pool is being applied around the world today, but we propose that a more effective way, right, is to come up with an appropriate interest rate subsidy, right, for the SMEs, right? So instead of just having that funded pool there, which has some weak incentives, we feel that a more direct way and more effective way, based on what our model suggests, is to provide interest rate subsidy, right? And then the question is, how do we calculate this optimal price, this benchmark price of this interest rate subsidy, right? So we need to look at the price of the default risk. Again, we apply our Wang Transform. So we always go back, right? Whenever we encounter a problem, we go back to our first principles, right? Our theoretical foundation, right? That's the key idea that we hope to propose here in our model. Here, we just use a very simple case where the recovery rate is 0. But of course, you can say it's a 25%, 50%, 75%, or even make it a function of the loan amount, right? But for tractability of our mathematical formula, we just use a recovery rate of 0, right? And the key idea here is with Wang Transform, right, we are actually able, again, previously we showed that we can convert the objective default probability to our risk neutral default probability. Here, the same thing, right? We can convert our real interest rate to our risk neutral interest rate using our Wang Transform, right? And the key idea here is this actually provides a very nice benchmark or like a framework for the government to decide, or even for the banks themselves to decide what's the appropriate risk neutral interest rate that they should actually be charging these SMEs, right? So yeah, in the past, we have no idea how to, right? But because of thanks to Wang Transform, we have a very nice formula that allows us to convert between the two, which is very powerful, right? Yep. Until 11, about 5 more minutes before Q&A. Right. So
yeah, there are 2 questions already, Jing Rong.
Okay. Cool.
Yeah.
Sure. Should I answer the questions first, or should I like finish up in like 5
as you like, you can
minutes?
see them so, right? So yeah.
Okay. Oh yeah.
Yeah. So the first is about default. I think it's a question on where the real world default probabilities are obtained, because you mentioned some recovery rates, right? Assuming
Sure.
yeah. Another one is on the yeah, as you can see. Yeah.
Sure. Yeah, I'm reading it now.
Okay.
So yeah, maybe I just answer while I go along, so it's easier to follow for everyone. So yeah, I start from the top. So yeah, great question, Chan Wai. So in terms of default probability in the real world, so our government partners, they do have those numbers. They have state-owned banks as well. So we are able to get numbers from the banks, from our partners, and from a more research perspective, academia perspective, there are databases, at least in the US, from what I know of, that have like the default behavior of companies, which allows them to proxy for the distance to default. Yeah, like somehow of the Journal of Finance, like how they actually proxy for the default probability. So I think there are some databases but some of them, I would say, at least for the US one, I don't think it's free. And the government partners, it's proprietary as well. So so we probably need, it's not like publicly available data. So that might pose but if we do have the information, we can, like, based on the model that we have, we can actually plug it in to get a risk neutral probability, which allows us to conduct the analysis. But yeah, great question. Let's see the second one. It's a fairly long one, so maybe I read out to everyone as well. Definition of good versus bad. We have the intrinsic value as a function of the viability. Yeah. So we measure it based on the mu, right? So the drift term, whether it's upwards or downwards. COVID has, yes, I agree, they have changed consumer behavior, and some of these changes may be permanent. Exactly, I cannot agree more, right? As you can see now, like Google, Facebook, they are allowing the employees to work from home now. Like, it has changed how people work. So I agree entirely. Some business models may no longer be as viable, profitable, and IV will take a permanent shift. How the calibration of such permanent change. So that's a great point, right? I feel that, so essentially, I guess the idea is saying, what our model provides, right, is essentially probably a more naive approach when it comes to comparing good and bad firms, right? But of course, because of COVID-19, how these good and bad firms behave, right? How these good and bad firms change, it will be affected over time, right? Naturally, like some of the companies, they close down or whatnot. But what we essentially want to propose here, right, is that by focusing on the first level effect, right, what our paper proposed is essentially the first level, the first order effect of how COVID-19 affect the firms, right? It allows us to take immediate actions. What the question proposed is essentially like the second order, like because of changes to COVID, how does that affect the firm? I think it will definitely be a very interesting extension on what our models can actually propose, right? But I think it's a great question. Does the Wang model works for SMEs in all industry? The SMEs that default and generally come from? So I think that's a great question. Essentially, what the Wang Transform model does is that it allows for a way to, why did the question disappear? Oh yeah,
no, it moved up.
Oh yeah, it moved up. Yeah, okay, maybe I give it a thumbs up as well. Yeah, so essentially, one model, for it to work, right, we need to have real world data to estimate, to proxy for the lambda parameter, right? And the key idea here is there's no restriction on the industry, simply speaking. But the restriction per se is the data, naturally. If we have data, and of course, if we have more granular data, like if we have data from the financial industry, then we can proxy a Wang transform that's specific to the financial industry. Likewise, if we have data on like the groceries, right, the F&B industry, the SMEs for F&B, we have the information, we can plug Wang transform, right, for that industry as well. So yeah, the Wang transform is applicable to different industries, right, given that we have the information. And at the same time, the default in COVID situation, yeah, I agree, it comes from a few industries. Particular industries are affected, some are not so affected. But ultimately, what we hope to propose here is our Wang transform here is actually quite generic, as we mentioned earlier. But for the purpose of this COVID-19, we made a specification to, like, we use COVID-19 as like our application, like to specify the models under COVID-19, but it can be more general for sure. In terms of other like financial crisis situation, right? It can be applied as well to those situations, which can naturally affect other types of industries. So yeah, great questions. Okay, then let me highlight some of the, maybe I focus on some of the key things, the more interesting. What's this? Yep, so in Singapore, right? So in Singapore, a type of interest rate subsidy is like the MAS SGD facility. It's not really a subsidy, right? But it's similar. Essentially allows banks to borrow at a 0.1% rate, and therefore this like they get this subsidy from the government, and thereafter they can pass on this lowered cost of borrowing to the SMEs, right? But the key idea here is this lowered cost is generally level, right? I think before this MAS SGD facility, before that the lending rate was I think around 1% there and about. So essentially lowered the cost of borrowing from the banks, the local banks, by about 90%, 80 and 90%. It's a level decrease. But what our model suggests is that we can actually allow for a more individualized calculation, as what the question suggested, maybe for different industries, right? With information from different industries, we can do a more individualized calculations of our interest rate subsidy for different types of SMEs. Right, so ideally, it can maximize the efficiency of government subsidies, because otherwise, an SME that is not that affected, right, will still be able to qualify for this lower cost of borrowing. So in a way, this SME is kind of over subsidized, whereas some other SMEs who is very badly affected, they also get the same level of interest rate subsidy. So they are under subsidized in a way. So that's a potential issue with a level cost of borrowing. But what we have here, what we propose is this customizability allows us to maximize the funds that the government is actually putting to good use, right? And making sure all the SMEs get the optimal amount of assistance that they actually need, right? So that's something that we feel is very powerful with what we are proposing here. And yeah, so we have confidence intervals. Yeah, there's a lot of very interesting snippets information, right, in the paper. Maybe if I can focus on one last key idea, right, is we actually, so before everything is all very theoretical, right? And then people will be thinking like, how realistic is this? So we actually applied our models to some real world data that we actually got from some of our partners, right, our government partners. And yeah, the key idea is we found that essentially for our large and commercial banks, the risk neutral interest rate that they are actually charging is just less than 5%, right? And at that point in time, the prevailing interest rate over a time period that we're looking at is exactly 5%, right? So it ties in very nicely, right? Based on our Wang Transform method, we calculated this independently, and we found that it's actually just below the prevailing interest rate. So it provides like firm support for the models that we are proposing here. Whereas for the more community banks, which we suggest that essentially these community banks, they probably have a higher concentration of SMEs, and they usually have a greater difficulty in accessing bank loans. This actually makes the case for governments to actually focus more of the support to the community banks, right? Because at the end of the day, they are the ones who are servicing the SMEs, the ones who really need the support and the assistance. And yeah, so maybe I conclude here. We have Wang Transform in the theoretical framework, which allows us to do a conversion between our objective default probability and the risk neutral Q, and also the interest rate as well, right? And we did an evaluation of different government measures. We came out with novel measures to support the bank's underwriting capabilities, which unfortunately I don't have. I didn't go through as much. And finally, yeah, most importantly, ERM for SMEs, there's still a huge growth potential for them, because at the end of the day, we believe that SMEs, they form the integral backbone of any economy around the world, and allowing them to better manage their risk from a more enterprise, from a more professional way, it's a win-win situation for a lot of people. One of the person that will benefit from this is other banks as well, because they'll be able to better underwrite SMEs if they have proper ERM systems in place. And yeah, with that, thank